The stock market just dropped 2% in a single day, and your neighbor is already texting you that the economy is collapsing. But what if that 2% drop is actually one of the most normal, predictable, and even necessary things the market can do? We throw around words like pullback and decline like they're financial curse words. But understanding what they actually mean could be the difference between panic selling at the worst moment and staying calm while everyone else loses their minds. A pullback is simply when prices fall somewhere between 5 and 10% from a recent high. Think of it like a rubber band that's been stretched too far, snapping back just enough to find its natural tension. Now, a correction, which sounds even scarier, is a drop of 10 to 20%, and a full bear market means prices have fallen more than 20%. And yes, those last two have a way of making financial news anchors speak in their most dramatic voices. The irony is that these events, which feel like financial emergencies, are actually baked into how markets work, the way turbulence is baked into flying at 30,000 feet. Just a year or two ago, headlines were celebrating record highs. Retail investors were feeling invincible. And social media was full of people who had apparently cracked the code of getting rich effortlessly. Then the mood shifted, not because the world ended, but because markets, like human beings, cannot sustain irrational exuberance forever without eventually needing a nap. Psychologically, this is where it gets dangerous, because the moment prices start falling, our brains wired for survival start screaming that something is deeply, catastrophically wrong. Experts like behavioral economist Daniel Kahneman spent decades documenting how we feel losses roughly twice as intensely as we feel equivalent gains, which means a 5% drop hits us emotionally like a 10% win never could. Here's the historical reality though. Since 1950, the S&P 500 has experienced a pullback of at least 5%, roughly 3 times per year on average. And the market has still compounded wealth at approximately 10% annually over that same period. Every single one of those drops felt different in the moment. There was always a reason, a crisis, a geopolitical tremor, a Fed decision, and yet the pattern of recovery has been remarkably consistent. Think about 1987's Black Monday, the dot-com collapse of 2000, the 2008 financial crisis, or the COVID crash of 2020. Each one felt like the unprecedented end of something, and each one was eventually followed by a recovery that rewarded the people who stayed rational. There's a humbling lesson there. The market has been declared dead more times than a horror movie villain, and it keeps getting back up. Markets move in cycles, the way seasons do: expansion, peak, contraction, trough. And recognizing where you are in that cycle doesn't require a PhD, just a little patience and historical perspective. Smart investors and analysts like Howard Marks have built entire philosophies around this, reminding us that knowing we're somewhere in the middle of a cycle is often enough to make better decisions than pretending we can pinpoint the exact top or bottom. One of the biggest misconceptions people carry is that a declining market means something is fundamentally broken, and that getting out is the only rational response. But that's a bit like leaving a restaurant because the appetizers took too long, right before your meal arrives. Prices falling doesn't mean value has disappeared. It often means assets are going on sale, which is exactly the kind of thing long-term investors should be quietly celebrating rather than fleeing. So what do you actually do when you're staring at a red portfolio and everything in your body is screaming to sell? The practical answer, drawn from decades of market data, is boring on purpose. You stick to your plan, you don't increase your position size out of stubborn conviction, and you let your pre-decided rules, not your emotions, drive the decisions. Discipline, not brilliance, is what separates investors who build wealth from investors who just have a lot of interesting stories about the ones that got away. Position sizing matters more than most people realize, because even if you're completely right about a stock's long-term direction, being overexposed when volatility hits can force you to sell at exactly the wrong time just to cover other obligations. The process, having rules, following them, reviewing them calmly, beats any hot take or market prediction you'll ever read in a newsletter at 2 in the morning. There's something almost philosophical about accepting that you will never buy at the perfect bottom or sell at the perfect top, and that this is completely fine. Consistency over time, combined with rational sizing and emotional discipline, has historically done more for wealth building than any act of perfect market timing ever could. At the end of the day, A pullback isn't a verdict on your financial future. It's just the market breathing. And the most powerful thing you can do is breathe with it rather than against it. Whether prices continue to fall, stabilize, or recover, being rationally prepared for any outcome is not pessimism. It's the most optimistic thing an investor can do for themselves. And if all of this makes you think about taking a more intentional approach to building wealth through other avenues, whether that's real estate investing, home contracting projects, or finding the right lenders to help you get started, check out our links in the description below.